Tonight is Thursday, August 23rd, and I'm going to review a few charts quickly tonight, mainly focusing on stocks. It's pretty simple what's going on here right now, and I want to highlight the main point first here. So if you pay attention to anything in this video, the important stuff is going to come first. And that really has to do with how to judge a breakout here. Now, this is a chart of the S&P 500, so this is the S&P 500 cash index here. And currently the market has attempted to break out of this April 2nd high. So Tuesday it ran above that high there at 1422 and made it up to 1426.5, and then it reversed below. Now here's the simple concept. Oftentimes when a market first makes it to a breakout or breakdown point at support or resistance, there will be an initial failure, and if the market then breaks to new highs again, that will be a continuation point of the rally. Whereas obviously if it doesn't break to new highs, that is a failed breakout. So really at this point, my personal take is that the odds are reasonable to probably in favor of this being a failed breakout. If that is the case, then based off of the typical patterns we've seen since the year 2000 and patterns that are very, very common across many different markets, I wouldn't expect to see the market come up and break this high. That would not be typical of a typical failed breakout in a market. If it pushes to new highs, that would typically be an indication that there's a good entry point, good low risk entry point for a long trade. So you'd buy on a stop on a break to new highs with a sell stop below the low point of this pullback. So we're going to go back through some of the charts that I talked about in a post over the weekend, looking at the last decade's worth of bear market highs and lows. And let's just go back here a little bit. So at the end of the 1990s bull market, the market ran up, obviously the greatest bull market in history of stocks, and there was a pullback lasting a couple months here before the final price spike up. And at that final price spike, what we saw is here was the prior intermediate high. Price barreled through that. It went up for about 3 more days, formed a bearish candlestick pattern, in this case a long-legged doji candlestick, and then the market never made it back above that high. So there was no swing high here, and then further breakout attempt. As soon as we saw the swing high after the breakout, that was the final high. The market did experience a sharp correction and then form kind of a wedge type of pattern before ultimately leading to a significant long-term decline. So that one did see a modest breakout, 4 to 5% there above the prior high before reversing. But again, as soon as the breakout failed, that was the final high. If we go to the 2002 bear market low, we'd seen the market making lower lows, and then you have this panic low here in July of 2002. The market rallies for about a month upwards, and then as it's coming down here, everybody's watching that low. What's going to happen at the low? Are we going to have another breakthrough point kind of like this? And what happened is when a market came to that low, it broke it by a fraction, reversed above, never to go below that low again. Now if we back up on that chart and let's look at the prior low there. So this was the prior low. I'm gonna hold my cursor at the low of that level there. So we saw here the market broke that low, and then it promptly reversed up, and you'd say that kind of looks like these other successful reversals. However, when the market came back down and broke that low again, look, that was a beautiful continuation point. So the market then entered a very vertical type of decline after that, and so you'd be safe on shorting on a sell stop in this case with a stop above there. So basically what I'm looking at in the current market is just the flip side of that. So if we have the market now has broken this prior resistance and immediately reverse. That's kind of what we just saw on that chart, but upside down. Now if the market comes back up here, you could enter on a buy stop here with a sell stop, good till canceled sell there, and that would be for a continuation move up there. But if the market is to continue to decline, we should not see a push up above that high. At the 2007 market high, we saw this sharp sell-off from July to August, and the market rallied up, back up sharply, moved above that high, formed a bearish engulfing pattern, and again was never to break back above that high. And at the 2009 low, now volatility tends to be lower at the bottom, so this one did have a decent break. So here was the November low of 2008. The market broke through that low, gapped down, made a quick sell-off, but came back above that low. And as soon as we saw that, the market regain back above this prior low right in here, we never saw it break to new lows again. So those are the examples that we've seen since the end of the so-called secular bull market there in 2000, and I think that's what to look for here. So it's pretty clear cut. I personally am short, or have recommended short positions based off of this reversal here. So short from this level right there, so we had some follow through today. So as long as the market remains below this high, this short position should be good. If the market gets stopped out of here, I wouldn't want to be short. There would very likely be a continuation there. So that's what's to look for in stock. So if you remember, take anything away from this video, take that away. That pattern happens very frequently in markets. Let me just show one more example of that from last year. So here we had the March 2011 low, and the market made a high on May 2nd. And when the market came back down, and with this day here, this hammer candlestick, that broke these lows, it broke these prior two lows, and then it immediately reversed back above them and closed above those lows. Now what we saw the next day, again, if you follow this strategy, is if you would short on a sell stop on a break to new lows there, with a buy stop above the high of whatever rally takes place, those are the times when you get good continuation point. So you don't typically get good continuation on the first break above a prior support or resistance level. It'll typically break, come back above it, and then it's that next break that will really give a strong continuation point there. So I'll leave that alone for now, but just want to make sure that that is very, very clear as far as the expectation here. If the market moves higher above this week's high, the expectation should be for it to move higher. And if it does not, then we will likely see a significant correction here. Now, as far as some of the indicators, this is again the same. This is the S&P 500 cash again on a different charting system here. This is the ADX indicator down here. Again, this measures trend. So we've seen this extended trendless period here from June into August. As this rises and moves back above 20, that indicates a new trend. So as of today, it's at 19.37, so it's getting very close to a stable trend level. The market has been moving up, so if the market does continue higher and breaks above that high, then we would have indication from price, from the failed from a successful breakout pullback, and then a second breakout pattern, and then we'd have indication from this ADX that a new trend up is stable. So those would both bode for going long on a break to new highs. However, currently we've seen a failed breakout, so as long as the market remains below here, I would just use this as a warning of an uptrend, but I think the odds are reasonable that the breakout will fail here. Now, some of the indicators to look at on a weekly chart of the S&P 500, the weekly stochastics is overbought. It's been overbought for a couple weeks now. The Bollinger Bands are still channeling, so we really haven't seen them start to expand out, indicating that there's a high volatility move coming yet, and we don't have any indication necessarily that the new trend will be up or down from that. The daily time frame here, let me click over to the Russell 2000. Russell 2000 did not was not able to break above its spring high, but it did break above this July high. It's lagged the other indexes here. It's been weaker, and then it failed on that breakout and has reversed lower. You see the stochastic, so the daily time frame stochastics has been overbought. It made a trailing one-bar low sell signal yesterday, and that was the signal to enter a short position there on one of the methodologies I use for trading this. And when the stochastics lines get back below 80 there, there's often, if you look at some of these prior instances there, you will sometimes get continuation of the downward move once that gets back below 80. Then on an hourly time frame, I've been noting this building bearish divergence in the MACD. So there's been a 3 push type of pattern. So push 1, and then a pullback in the MACD, and then another push up in price, and then a pullback in the MACD, and then a third push up in price, all like successively lower highs on the MACD. We've now had the market break the uptrend line here, and both MACD lines are back below 0. So this could have some more room to the downside. As far as how to gauge whether a significant high or a low is in, that's what these lines here project. Those 4 lines represent the biggest corrections. So here, 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 and here, those are the biggest counter trend moves within this uptrend here. So if the market gets larger and more time consuming, or larger and faster than those corrections, then we do have some indication logically that the price move beginning here is starting a new downwards trend, or at least a new downwards pattern correcting this uptrend. What would really give us solid price confirmation that this uptrend may be over is if this last leg up is completely retraced in less time than it took to form. So that's what these vertical lines represent. So if we take from here what I have labeled as B up to here, which is what I have labeled as C, this vertical line here represents that time projected from the high. So if the market comes back down below this level at B, so around the 136 level on SPY, or excuse me, 135.50-ish. So if the market's back down there before that vertical line, that would be good logical price confirmation that the power has shifted to the downside. That doesn't always mean that's a perfect time to enter short positions. It may be better for it to break that support, rally up a bit, and then look to short at a lower high on the hourly chart. This is a chart of USO, which is the U.S. oil fund. So this fund tracks the prices of oil relatively closely, and coming off of the June low, we've seen a pretty dramatic rally in oil prices since then. And obviously there was a very large, very fast decline in oil prices going into there. So the larger and faster the downward moves are, typically the more explosive the corrections are on the way back up. So we have seen an aggressive rally since then. We may be completing somewhat of a zigzag type of pattern here, so possibly in like a ABC X and then another ABC pattern, or just a standard type of ABC pattern upwards here. We did see a bearish engulfing pattern today, so the market gapped up. It did make a new high above that high, and then it closed outside there. We got a stochastics cross today, so we do have some indication we should see some more downside from here with a stop above these levels. Looking at the hourly chart, we have something similar to what we saw that I just showed in the S&P 500. There's a bit of a 3 push pattern here. So off of this initial low here, we saw a strong push up in prices, made a high in the MACD. We saw a pullback, we saw a push to another high, made a lower MACD high there, saw a little pullback and another push to a slight new high, all along making lower highs there. So what to look for here is we already have a nice sharp move down in oil at the end of the day here on Thursday. That may indicate the completion of this upward leg. So the hourly MACD is in a sell signal. If these both cross down below 0, that will be some indication that we'll see some further downside from there. And also this uptrend line from the beginning of the pattern, if that gets broken, that's some further indication that this upward rally might be complete. So what has been happening here is stocks and commodities have been moving more or less in unison. And I'm going to click over here to this is a commodity index ETF, so will roughly approximate the CRB index. And we saw a dark cloud covering pattern today in this ETF, so we had a gap up. The market came down and closed. It's almost an engulfing pattern. It almost closes below the real body of the prior candlestick, but it might be a couple of cents above there. But in any case, that is a bearish reversal candlestick pattern. And if you look at this price move here, from here to here, there's actually a divergence on the MACD. So we made the high in the MACD right there, but we're at a lower high here on the MACD relative to this price high. There also is a bit of a strong move up, a down move, and then a 5-wave move up here. So in Elliott wave terms, we might be seeing a completed pattern from this point here. So divergence is starting to show up after some pretty significant price moves. Even if this, even if this turns out to be a significant long-term low in commodities, we'd probably expect some type of a corrective move back down towards, one of these lows here. So we should see a healthy correction of that rally at a minimum. This is a chart of the Mcclellan Oscillator. So the Mcclellan Oscillator is a kind of a smooth measure of breadth or advancers and decliners in the market. So it works somewhat like a typical oscillator. I find it to be useful in a couple capacities. One is the midline is at 0, so that'd be a very neutral reading. So when the reading gets very, very high, above or below 0, outside of the average, that can be significant in that the market is running a little bit too strong one way and is due for a consolidation. And the two main pieces of information I get from that are when you see a very, very strong spike, especially coming off of a let's say the market has corrected significantly and then you see a strong spike upward, that is indication that a kickoff in a new rally stage. So you see strong breadth spikes early in a rally, but then at the end of a rally you'll see divergences show up. So just going back here, if I remember to last year, there was a dramatic price decline into the August low. There was a rally, and then there was a break to new lows in October, in the first week of October, which eventually led to a very sharp rebound in prices. But if you look at the Mcclellan Oscillator, it was very, very low in August, but there was this huge bullish divergence in the Mcclellan Oscillator at the October low. And at the highs, we've seen a similar thing in the past, where the market will make a high in the oscillator prior to the stock market making a higher price high, but the indicator making a lower price high. So that's what we're seeing here. This is the high from the first week of July. So we in stock prices, let's say stock prices were here in July. Now stock prices are up here, but here's where the Mcclellan Oscillator is in July, and we have this dramatic lower high there. So this would indicate to me the market, there's some underlying weakness there. The market is probably not ready to rocket up into a stable trend. I think this could be a failed breakout scenario. But in any case, what we saw happen, we saw a similar thing happen around New Year last year, which is the Mcclellan Oscillator made a high on the October rally. So that would be right here. So the Mcclellan Oscillator spiked up off this October low and made a high. So that would be right here, and then and then it pulled back, and then as stocks were making higher highs here in January through February up above this high, so the stocks entered a tight trend, the Mcclellan Oscillator just kind of coiled tightly and remained below that high there. So they saw them just kind of coil tightly there. So it's possible that happens here. So if we see that ADX indicator continue to rise above 20 and prices make a new high for this rally, we might expect something like that, and it might to some extent erase this divergence. But currently this is a powerful divergence, and with the failed breakout thus far, I think it should be respected. As far as the price pattern there, the price pattern to me indicates one of two possibilities, I think, one more bearish than the other. Let me click over to a daily chart of SPY. One possibility here is that we have an A, B, C, D, E pattern, so this is completing a triangular type of a pattern, and if that does complete the pattern, we should see a pretty dramatic move down back below this point D. So in probably significantly less time than this rally took, so less than 2.5 months, we should see the market back down below the 127 level in SPY if this is completing a pattern. The other option that I'm looking at here is that this whole pattern up since the bear market lows in 2009 may need to have another decline back down towards this trend line here, and then another rally back up towards this trend line. That would still imply probably a dramatic sharp move down here initially. The question is, if this whole pattern up here if the whole bull market is topping here, then we may see a dramatic move all the way back down below this low in relatively short order, maybe within a few months. However, if this pattern still has some more sideways to upside action in it throughout this year into next year, then we may see an initial sharp move down but stall out somewhere around these levels and then a rally in the future. So time will tell with that. What I do know is objectively the MACD on this break to new highs is currently at a much lower high, so we may be setting ourselves up for a situation kind of like we saw in the MACD at the either the bull market highs in 2007, where the market had that failed breakout that I showed a few minutes ago. There was a strong divergence in the MACD. Very similar thing happening here, so just on a pure technical analysis basis, I think you got to respect that as a possible failed breakout scenario. We saw the inverse of that happen here at the bear market low in 2009. We saw a somewhat similar thing happen here in 2010, but that was a much more successful breakout that led to this mild divergence here in the MACD. So this is a lot sharper of a divergence. So could be seeing some pretty dramatic downside here starting very, very soon. So I would lean towards the short side here. Be wary of failed breakouts on growth stocks. So if you see, like for instance, Apple has broken out of if you look at this as a cup with a handle, it broke out here at 620. It's made some price progress, maybe 8% or so, but if it comes down and closes back below that breakout point, that's not good for a healthy breakout of a basing pattern. You can see it break out and then you can see it retest, but it'll typically remain above the breakout point, especially on a weekly closing basis. And if it does pull back calmly and then you get a buy signal on the stochastics, that would be sensible to buy there. But if this comes down and closes below that 620, that could be an indication from the world's biggest stock that these breakouts are failing, and we're going to see some significant price side ahead. So I would watch those indexes, and I would watch Apple to gauge the health of this breakout here. So that's really all for this update, and hopefully we'll have more to go on next week. This weekend we'll get the new commitment of traders report, and I think that should be informative because the market was basically up into Tuesday, and it tried to break out of that April high on Tuesday. And so we'll see if the smart money was selling into that breakout, or if they bought the breakout, or if they were relatively neutral. So if there's any type of a selling spike there, then we have indication that the bigger players are again defending that price level, and it may be likely, increasingly likely for the breakout to fail. So that's it for tonight. See you next week.